Welcome to the Daily Update, where I'll go over the action in the market for Wednesday, August 9th, and then we'll see how things look for Thursday, August 10th. We're losing support. We're already in a negative environment. We were short-term oversold, saw a little bit of a bounce on Tuesday. Well, we gave that back and closed pretty much near the lows for the session, and we're closing below support. Now, just ahead is the CPI that's going to be coming out on Thursday. There's a lot of anticipation about this. Is the market going to be able to bounce from that if it's a favorable report, or are they going to be disappointed and we're going to see more of a decline going forward from here? That's kind of the question that's on the table. The market really tried hard to hang on to those support levels, and I'll go through the charts and show you that, but we're starting to really drift below them. Any more catalyst to the downside could really turn things a lot more negative. Please keep in mind that I'm thinking about doing an online course. I've had a few people respond, so that's usually enough for me. I don't care, one person, two people. I'd like to have 1 million, naturally, but the idea is to teach whoever finds value in what I'm doing, and numbers aren't all that important to me. I'm trying to come up with a list. One person did respond saying they'd like to learn a little bit more about strategies. It'll probably be at kind of a high-level discussion where I can't go really deep, because behind a lot of these strategies is also theory, and so it can be a little bit long, and that's what I cover in my fuller-length courses. So just be aware of that. I'm trying to hit this at more of a high level. Another area that I've been thinking about is support and resistance. That can be such an open-ended area where you don't know what is support, what is resistance, where are we looking, is it this market, is it that index, and it can be really confusing. And then over on the right-hand side, kind of what I want to do is spend some time just talking about my whole approach to technical analysis. You know, I'm a lot different than most folks out there. They just get one or two indicators and focus on that because they're afraid of the old analysis paralysis. I have a completely different mindset when it comes to that, where you can't just whittle everything down to one or two indicators, and I've kind of learned that over the course of 35 years of watching the markets. So that's kind of what I'm coming up with, and maybe going into some mental analysis. That's the big one, is getting over your emotions. Because you can learn the strategies, you can learn technical analysis, but if you can't get a handle on your emotions, none of that's ever going to matter. Please feel free to offer some feedback as to what you might like me to cover in these different areas. And also keep in mind that I stick with the S&P. Everything that I talk about flows into the S&P 500. I don't really go into individual stocks. I might look at them for how they're impacting the overall market. I look at sectors, but I'm not involved in sectors. I'm mainly just studying it for how does it affect the S&P for the most part. All right, let's go back and talk about what happened. Right at the open, we had a lower open. Prices fell below the daily pivot at 44.89. We declined down below S1 at 44.75. Came back down to yesterday's low, so we're kind of establishing a support level there now. We did rebound back above the daily pivot, and we got all the way up to the unchanged level, which on a down day, that acted as overhead resistance. Prices then declined. We went down. We went back below the unchanged level, back below the daily pivot, and we closed near the previous low. We were down 0.7% on below average volume. A lot of apprehension ahead of the CPI coming out. It's also the summer months, so you have people that are kind of taking some time off. The technicals are negative right now, and in the short term, you could suggest that we're a little bit oversold. We're not oversold in the intermediate term. There's more room to run to the downside if that's what the market wants to do. We're also losing these support levels, which it's going to take some kind of a catalyst to try to get us back above those levels. And things could still turn and go back positive. We're just not seeing that yet. What are some comments that we can make? Support is being lost. Yes, we've already lost it, but until we kind of leave this in the rearview mirror and start going down, I'm still hanging in there with the idea that maybe we can regain that, because sometimes it can be a fake out. You've got a lot of people watching the same levels at the same time. There's a lot of stop losses at these levels, and if we start to go down, it might be just enough to have a fake out. Until we can really evaluate this over the course of a short period of time, we're just saying that support is being lost. The S&P is now under 4,500. On a short-term basis, we have the Stochh RSI, Williams Percent R, the CCI 14 and 20, and the stochastics are showing extreme negative readings. You could also suggest oversold. These are our usual suspects. The dollar was down and interest rates were up. The 30 to the 5 still is looking more normal, where the other yield curves that we follow remain inverted. Sentiment is positive. We're at 67. We ticked down from 69. Looking at our trend, we have had a change here. We are now negative with the ADX. The red line has crossed below the green line, but the ADX itself continues to weaken because it's below its moving average, and we're still above 20. So we're still in a trending environment, although that trend seems to be weakening. Our bias is negative, and our momentum is now negative because we've lost those support levels. Economic reports that came out. We just had the weekly MBA mortgage applications index. Overall, it was down 3.1%. Purchase applications were down 3%, and refinance applications were down 4%. Here is a chart showing how we have been declining, but this has been chopping above and below zero. Since this is a weekly chart and it kind of comes and goes, it could be the weather, it could be news, it could be whatever's happening. This is a pretty volatile measure that we look at. Some IsabelNet.com blog charts, where our first chart says the market is pricing a terminal close to our view, but lower than what the Fed was saying in June. This is when is the Fed going to top out and then start coming down with their rates. Where the Fed funds rate is the dark blue line. That's where we're at right now. This gray to bluish triangle, this is what the Fed says will happen. Deutsche Bank is the red diamond, and they think things will decline going forward, but Deutsche Bank thinks that the decline will end up being faster than what the Fed fund futures are predicting. Looking at the 10-year S&P 500 total excess return over the U.S. Treasury notes against the CAPE, that's the Robert Shiller PE ratio that we use. This is just suggesting that valuations exceed when the CAPE gets above 30, which is what I've been pointing out in the weekly videos. The long-term buy and hold investors can generally benefit more from purchasing 10-year Treasury bonds than U.S. stocks. That's because the interest rate is going up, the market is considered to be expensive, and so it's usually considered to be safer to be in bonds rather than stocks. We have the S&P 500. This is a daily chart with the moving averages. These are different things that I try to point out in the videos that I do. They've also marked some different support or resistance levels here. Notice right here where it says 44.50. When you look at the trend line of the chart that I've been showing, that's just about what we're getting for support as well. So that's kind of coming together as a critical support level. The survey of professional forecasters who think that we're going into a recession, it's still pretty high, but it has been coming down from what they thought before. How many people are in gold right now? A lot of folks are still starting to pile into gold. Then we look at what's called the break-even point. This is the 5-year and 5-year forward breakdown rate. This is going up, which is not necessarily good for interest rates because there's more fear of inflation coming into the market. Where are we at with the GDP now? Up here in the right corner is the green area. That's what they're estimating it being. Anywhere from about 3.5% up to a little bit over 4%. Looking at earnings sentiment and comparing it with other areas throughout the world, the dark blue line is the S&P, and folks are more optimistic about earnings going forward. The gray line is the topics. That's Japan. They're a little bit more pessimistic with the stock 600, that's the EU, and then emerging markets are even a little bit more pessimistic about things. One chart that I found as I was plowing through Twitter, this is a seasonal composite during a pre-election year. The black line is what they've come up with for their historical tracking of the S&P. The red line is where we're at right now, where historically we do see some weakness, and this is lining up with other research that we're consulting, but then we see a bounce up out of that, still in August, and then some weakness. We see a little bit more strength at the end of August going into September, and then some more weakness before we finally hit bottom in about October, and then possibly again in November, before seeing a good end to the year. That's just the seasonal historical composite that they've come up with. I find these to be good, useful guides. We never trade exactly the same any 2 years, but these can be good little guideposts for us to get an idea. I definitely prefer this kind of an angle myself over folks that like to shift markets ahead 9 months or back 52.64 days or whatever they want to do. This to me has a little bit more sound logic, but that's just where I come out. Getting into our charts and analysis, where we did have a lower open, there wasn't much of a gap, but we fell below the daily pivot. We did hit bottom at a little bit below where we were yesterday, and then it looked like, okay, early morning weakness, later day strength. That's what looked like it was going to happen. We came all the way back up to the unchanged level, but instead of breaking higher, we turned and went back down and closed right about at the low for the day. The intraday chart, we were flat in the initial overnight session, then things spiked up. They were looking a lot more positive, but we started to trail off and pretty much went negative by the time the market opened. Here we see the decline, the bounce back, and the decline again, and we're showing a little bit of a recovery in the initial overnight session. Now, please keep in mind that everybody's waiting for the CPI to come out, so whatever happens before that, it pretty much goes to the back burner once that report comes out. Intraday, we're seeing both growth and value suffering a little bit, but growth outperformed just slightly. Growth was down, but it was down a little bit less for the large caps. It was down less for the mid caps as well as the small caps. And I'm finding myself watching this chart a lot more during the day. When we were seeing this negative action right after the open, it's like, okay, that's following what the market is doing. But then we started to see this coming back up and actually go positive before the market did that. And then we pretty much stayed more positive even though the market was declining. We ended up closing above this unchanged level. So there's still a little bit of strength going into growth when you compare it to value. Looking at sentiment, we're seeing fear starting to pick up as our Ulcer Index is coming back up to the moving average. The VIX is starting to tick up on the line chart as well as the bar chart. Volatility is also starting to pick back up as folks are getting more nervous about the CPI and then the PPI on Friday. The VIX to move ratio is also showing an increase in volatility. Looking at the 5-period simple moving average of the equity put call ratio, this continues to go up and that is a negative for the market. Longer term also showing how we're advancing. But longer term, even though this is turning back up ever so slightly, we still continue to decline with our long-term put-to-call ratio indicator. This fear gauge actually ticked down just a little bit, but it has been climbing lately. The other fear gauge is starting to turn up a little bit, so we're seeing a little bit of a mixed picture, but overall volatility is starting to pick up. Our risk-on, risk-off ratio is starting to decline, and we're seeing this come under a little bit of weakness now after it had been really going up. Advanced decline line studies, seeing a little bit of pressure based on price and volume, but we're still above the moving averages. This is kind of encouraging. When we had the upward move, we saw a breakout in new highs. And then we did decline based on price, but we didn't see a real expansion of the new lows. However, on our 5-period moving average study, we're declining as well as the 10-period. The advanced decline ratio, the blue line, which is faster, is slightly below zero. The red line is still above zero. We couldn't look at this chart yesterday. They fixed the volume problem that was having. We're right on the moving average with the accumulation distribution. This tries to measure what is the smart money doing, and when this is going up, that tends to be positive for the market. We dropped down below this moving average, and then right after that is when we saw some weakness in the market. Well, right now that we're on the moving average, that could mean that the smart money is waiting to see what will happen. Looking at the cumulative NYSE advanced decline line, seeing some weakness here, dropping below the moving average. We also saw a decline here, but we're still breaking out with our regular advanced decline line, and we're still above this trend line. This also is a bigger look at that same trend line, where we are still above that. The common stock, based on price, showed a decline as well as volume, and in the background is a longer-term negative divergence. Looking at our advanced decline line studies, we are seeing a decline across the board, but all of these indexes still remain above their moving averages. Keeping an eye on our trend, we're seeing the green line dropping below the red line as the ADX is weakening. It's below its moving average. We're still in a trending environment because we're above 20, but it is a weakening trend. We're also seeing this in our shorter term ADX chart with the red line now going above the green line. The ADX is also weakening and declining after it had been giving us a pretty extreme reading above 40. Volume, I was able to show this chart this time. We're below average as we're dropping off. Our short-term chart, we're starting to come back down and it's looking a little bit more like a decline right now. We were not able to get above this pivot level. We're coming down to the 50-period moving average. That might be another line of support if we continue to fall. Down below, you can see where we're really dropping off with volume. We're dropping below the 20-period simple and exponential moving averages, and they're just starting to roll over a little bit. Looking at our moving average study, declining with the 20, 50, and 200. The Stochk RSI is extreme negative. The Williams percent R is extreme negative. The CCI 14 is extreme negative. And the CCI 20 is extreme negative. Our stochastics getting extreme negative in the short term. coming back up a little bit in the intermediate term, but had been extreme negative, and longer term we continue to decline. Please be reminded that this is a subdivision of the short-term time frame. So this is short-term, intermediate short-term, and long short-term. The force index is below zero and declining and no longer extreme negative. Some intermediate term charts were below the dashed line with the balance of power. The go-no-go system is still more neutral. This could redraw and look more negative, but for right now, it's positive with a negative slant. We're coming down to the lowest low value, and this line is starting to decline, where our highest high value is flattening out, and we're below the midpoint. We're seeing the TTM squeeze starting to drop below zero. That's turning more negative. We're dropping below the midpoint of the standard deviations chart, and we're still just in the one standard deviation. We haven't really picked up a lot of steam to the downside, at least yet. Looking at our moving average tree, below the 20-period moving averages, if we start to fall, we'll be watching the 50-period moving averages, which about the time we get there might be around that 44.50 level. Looking at the ease of movement on the 14-period, we are below zero and declining, even though it ticked up a little bit in Wednesday's session. The Erin is also flattening out. We're seeing a decrease in buyers, also a decrease in sellers, so it's not really picking up any major differences. The S&P McClellan oscillator is below zero and declining. That's negative, so we are declining based on price and volume. The NYSE McClellan oscillator also below zero and declining, so the NYSE summation index is declining based on price and volume. The Swenlin trading oscillator turned up a little bit based on price and volume. Sometimes this can be a leading indicator for us, but it's also led us astray at times as well. The PMO is still negative, and we're also declining based on price and volume. Our PMO study shows that the PMOs that are rising is now declining. The buy signals are trailing off, and we're dropping with the PMOs that are above zero. We remain negative with the Elder's Impulse system for the S&P. We also remain negative with the parabolic SAR. The slope oscillator is negative, and now we're starting to drop below the midpoint. The MACD is also negative. So looking at all of our oscillators, we're negative in the short term. We're also turning more negative in the intermediate term, and the long term is starting to decline as well. The bullish percent index, after dropping below 70, continues to decline. That's now turning negative. It won't become full-blown negative until we drop below 50. The NYSE bullish percent index is also declining, but still above 50. The Chaikin money flow, showing that the smart money is getting out of the market right now, according to this chart. We saw that starting to trail off even before we saw the weakness coming into the market. So this is turning more negative as well. The Chaikin oscillator ticked down just a little bit, but is still below zero. The vortex crossed over negative yesterday and continues to be negative, even though the red line declined slightly. The RSI coming and dropping below 50 with the 14 period, also declining with the 9 period and not giving an extreme warning. The money flow below 50 and declining. Ultimate oscillator below 50 and declining. On balance volume coming down to the moving average. If we drop below this and then the moving average turns down, that would be more negative. Seeing a little bit of weakness with our 200-day moving average study, a little bit more weakness with the 50. And that only makes sense. The 50 period moves quicker than the 200 period moving averages. Some line studies here. We did start a new cycle August 1st. We're running into some problems. Is this decline going to keep going until the new cycle on October 11th? It rarely does that. It usually chops around. But what is the bias going to be going forward? We're dropping below the shorter term trend line. We're possibly coming down to this next trend line, which is at about the 44.50 level. Our different charts were negative. The Heiken Ashi is negative. The Renko is looking more negative. The Kegi is negative. And the 3-line break is negative. The different indexes, we're seeing the equal weight and the S&P 500 perform about the same, and they're both negative. Not seeing an awful lot of change in the ratio between the S&P and the equal weight S&P. Seeing a little bit of a decline with the Dow, but still above where it broke out. The same thing is true with the transports. Saw a little bit of a tick up with the utilities. Looking at the transports to S&P 500 ratio, it did decline, but overall still continues to advance. The relationship between the S&P and the transports is showing that they're having a tendency to go in the same direction. And right now that direction appears to be down. The discretionary and staples equal weight study, where we were up slightly with discretionary, and that's been hanging in there a bit. We ticked up a little bit with the staples, but overall the ratio did decline. Longer term though, discretionary is outperforming staples. The Dow still above this pivot level support, so that support is holding. Now what I had for a major support is the NASDAQ 100, the S&P, and the NASDAQ. We've broken below that. But this is a secondary support level that I've been keeping an eye on, and so far this one is holding up. The diamonds, though, have switched over to negative. The NASDAQ, we broke below this S1 level. We're also closing down a little bit below the 50-period moving average. Looking at the Fibonacci chart, this was one support level. We had been hanging out right at this level. We're now dropping below that. NASDAQ 100, also, we're maintaining this support level, going back to the previous high set in 2022. Now we're dropping below that and coming down to the 50-period moving average. The Qs have also turned to negative. The NASDAQ 100, based on momentum, continues to be negative. The NASDAQ BPI is also declining, but still above 50. If we see this continue to fall, that will be even more negative. The ratio between the Q and the diamonds continues to decline, showing that they're going in the same overall direction. The small caps also just above this pivot level. This was another secondary support level that I've been keeping an eye on. Looking at the Russell 2000 index, we're declining with the RSI and the MACD is negative. We have generated a recent golden cross, but we'll have to see if the small caps end up coming down to the 50-period moving average. The small caps remain negative for the Elders Impulse system. The new highs, new lows for the NASDAQ on a cumulative basis are starting to show more weakness, and we're closing down below zero with our raw score. The small caps to S&P 500 ratio did tick down and continues to be in a longer-term downtrend. Small cap growth compared to small cap value did tick up a little bit. Shorter term, it's more negative. Longer term, it's still in an uptrend. The mid caps did break a little bit below the pivot level. This was another secondary support level that I was watching, and the fact that we closed below that is negative. Also, we remain negative with the Elders Impulse system for the mid caps. We're also seeing a little bit more weakness with mid cap growth versus mid cap value, even though it ticked up slightly, but longer term it remains in an uptrend. The dollar was down slightly in Wednesday's session. The FANG index also starting to break below its 50-period moving average. That's another line of support that we were watching, and that has now broken. After coming up and setting an all-time high with the FANG index, we've been dropping back down ever since then. Keeping an eye on the banks. They're hanging in there fairly well. They're still dancing around the 200-day moving average, but they still are in an overall downtrend. The financial sector has generated a recent golden cross. That could be positive, but the financials continue to underperform the S&P. Shorter term, we've been seeing a little recovery when we look at the regional banking ETF and compare it with the financial sector, but longer term, it's still in a downtrend. Keeping an eye on bonds, we were up slightly with yield. We were down slightly with price. We've also been watching this for quite some time when we compare cash to the 3 to 7 year bond ETF. In a more confident environment, we would see this ratio going down. In fact, it's still continuing to go up. But folks are still favoring riskier bonds over more conservative bonds. That's more positive since people are willing to take on more risk. Here's the 30 to the 5-year yield where we're crossing back above the zero line and looking a little bit more normal. Our long-term charts still positive with the daily special K chart, although this is rolling over. Our PPO studies, seeing a little bit of weakness in the intermediate term. We're dropping below zero in the short term. Please keep in mind this is a weekly chart. We're dropping below this resistance level with the weekly chart of the S&P 500. Is this going to continue to go down? Are we going to find the ability to get back up to this level? Saying kind of that same thing with the NASDAQ 100. It's dropping below. Will we see a recovery from here or a continuation of the decline? Longer term, and this is negative, we're seeing this ratio coming down slightly. When we had a real high reading between the NASDAQ 100 and Dow ratio, the other time that happened was in 2000, right before the dot-com crash. Then it took us 20 years to get back up to this level. The last time we saw a really high reading was right before things turned south in 2022. We're wondering, is that going to happen this time, or are we going to be able to turn this ratio around and start to go higher? Here's the weekly chart showing where we topped out 2 weeks ago now at this R1 level, and we've been declining since that time. An update of our possible positive scenarios, not really much to report. We are showing the Q underperforming the S&P and dropping below the moving average. Some weakness with discretionary to the S&P, but still on the moving average. We're seeing large cap growth starting to underperform large cap value, with our growth to value ratios underperforming with the large caps, mid caps, and small caps. The S&P to utilities ratio ticked down a little bit, but continues to decline overall. This could be in the background as something positive. We're also seeing something more negative when we look at the 19-day exponential moving average of the advanced decline ratio. We're dropping below zero based on price and volume. We're also dropping below zero when we look at the Amex, NASDAQ, and NYSE and take a 5-period moving average of the highs minus the lows. The 10-day average of the S&P 500 highs minus the lows continues to decline. We were camped out in this area for quite a while, but now it's starting to decline. That's more negative. The 50-period exponential moving average of the new highs minus the new lows, the red line is starting to come down. That's the negative part, but we're still above zero. That's the positive part. When we look at the black line, it's dropping below the moving average, which is causing the red line to roll over. When we look at S&P growth versus value, we saw it tick up a little bit. This could be more encouraging, but we need to see a lot of follow through with this. Longer term, we're still in an uptrend. Shorter term, we've been in a downtrend. Can we bounce up and start to see this ratio going back up? Looking at staples to S&P 500 and taking their ratio, it is going back up a bit, but this ratio has been declining longer term. Then, according to Tom Bowley, August is the third worst calendar month, where the energy sector is not hot and tech is hot. Well, we're seeing weakness kind of across the board right now, so we might see some kind of a bounce from there, but then going into the latter part of August, we tend to see some weakness. He's also suggesting, according to his research, that this is when growth really starts to outperform value, only to go up later on in the year. We're not really seeing that yet. We're seeing little glimmers of hope with that, but we're not seeing an awful lot of follow-through. So what's our outlook for Thursday? Earnings reports are coming out. Most S&P 500 companies should have reported by the end of the week. I think 80+% by then. The technicals are now negative and we are losing support. If we see more follow through, it's just going to reinforce the negative side. Now, the market could react in a real positive way to the CPI report, have the initial gyration lead to an overall advance, and we could turn things back more positive. But right now, we're leaning a lot more towards the negative side. We will get the weekly jobless claims. We'll get the CPI. Just so you know, I usually don't put this on here. They're expecting CPI to come in up 0.2%. Last time it was up 0.2%. The market liked that. The core CPI, they're also expecting to come in at up 0.2%. Last time it came in up 0.2%. If we get a number higher than that, that's going to really rattle the markets. If we get a number lower than that, that could really rally the markets. If we come in as expected, we might tend to lean a little bit more positive because this is what they think is going to happen. But in the background, our picture is more negative technically right now. It may just continue with this negative trend that has been developing. And we'll also be getting the Treasury budget. We're keeping an eye on all the geopolitical events, but right now it's about inflation and interest rate and what is the CPI going to show. Here's the updated economic calendar for the week. We are getting CPI on Thursday and PPI on Friday. Stock Traders Almanac statistics for August 10th, not looking really good. We're negative with the Dow and the NASDAQ. We're neutral to negative with the S&P. We're also wondering, have we been able to bottom here with the NASDAQ and start to see some bounce? At least that's historically what has happened. Will something like that happen this time? We will be on the 8th trading day of the month, where during pre-election years, we tend to see a little bit more positivity here. But when you take all the years together, we tend to see things more negative, which is what I just showed you in those previous statistics. Going back to 1950, we're 50-50 with the Dow being up or down during pre-election years. So looking at our scenarios, we are definitely leaning more towards the negative side. Our charts are really looking negative, and now that we're losing support, we're seeing those things coming together. Unless we see some kind of a significant bounce, we're really leaning more towards the negative side, which means we're not leaning to the positive side. And even though the ADX is weakening and it's starting to shift over from positive into negative, we're still above 20 with our ADX, so it's suggesting that we are in a trending environment. The warning signs. We did appear to see the short-term bearish signals all coming together, and that is what's led to this weakness that we're going through right now. Our longer-term signals may be suggesting that we're at a top. We just don't know that right now. We need some time for this to play out. Seasonally and historically, we are coming into a weak time of the month as well as the year. Our S&P 500 oscillators are negative. Also, the NASDAQ 100 oscillator that we've been watching is negative. The VIX is still showing a lot of complacency, but it is beginning to climb. The NASDAQ cumulative new highs and new lows are showing weakness. We're still above the 3-month yield of where we were back in 2007. S&P 500 growth is weakening, but in a longer-term uptrend. The weekly pivot that I showed you on that chart, it has acted as overhead resistance. We hit that 2 weeks ago, and that's where we ran into some problems. The parabolic SAR is negative, and the vortex is now negative. And then earnings season are on a case-by-case basis. The positive signs, we do have seasonality and setups that are way in the background right now. The daily special K chart continues to be positive. Our longer-term equity put-call ratio is positive. The S&P is above the downtrend channel upper line. We're in a risk-on posture. The S&P is outperforming utilities. The NASDAQ and NASDAQ 100, quite a while ago now, they broke above this overhead resistance. But they're having a real hard time breaking above daily resistance. If we start to fall, will this overhead resistance now act as support? The Staples S&P 500 ratio is declining. The Russell and small cap indexes, in addition to the mid caps, are generating golden crosses. And small and mid-cap growth continues to be positive. The financial sector has generated a recent golden cross. So our conclusion, we're negative and losing support as it stands right now. In the short term, we're negative and slightly oversold. You could maybe even go full oversold at this point, but those indicators still have more room to run to the downside. In the intermediate term, we are negative. In the long term, we continue to be positive. Thank you. I hope you found this helpful. I hope you have a really good day, and I will talk to you in the next video.